Tyler Crow, it happened.
It finally happened. We've been waiting how long?
It feels like 17 years, but it's really only about a year, I guess.
That seems much longer considering how much we've talked about it.
You're exactly right. And of course, what we're talking about is the Federal Reserve has indeed started lowering interest rates again. The 50 basis point cut, more or less what was expected. Looks like the Fed kind of threaded the needle of what the market was expecting and is telegraphing further rate cuts. Now, there's some bad with rate cuts, but also some good. We'll talk a little bit about both. We've got a couple of stocks that we think lower rates could help their business and help their stocks. We're going to talk through that right now. I'm Jason Hall. This is Investing Unscripted. He's Tyler Crow. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that special link. You can get access to The Motley Fool's 10 best stocks to buy right now. Again, you see the link on the screen. Go check it out when you get ready. Tyler, again, 50 basis point cut. Before we pitch our two stocks, what's the concern with interest rate cuts?
There's a dual mandate when it comes to the Federal Reserve and what they do with interest rates, right? It's to control inflation and to maintain full employment. The idea being that with interest rate cuts, it's kind of preempting any declines in the labor market because we have seen slowing job growth. Unemployment has ticked up slightly. So it's a little bit of a, hey, things are starting to slow down a little bit. Inflation's in enough control that we can cut interest rates a little bit to, a lot of people will say, normalize the job rate or the jobless claims.
Historically, when the Fed has cut rates, almost every time we're already in recession, or recession happens very quickly after it. And the whole goal of the Fed, like you said, that dual mandate, what it really comes down to is trying to support a healthy, stable economy. In the mid 1990s, they cut interest rates, and the next 6 or 7 years, the economy remained incredibly strong. And there are high hopes that that's what happens again. We're going to find out if it will. The downside is we go into recession, or maybe recession's right around the corner. The upside, Tyler, is you lower interest rates and it makes goods more affordable, especially things that you might need to use financing to buy. We have two stocks. How about you go first?
Sure. Well, this is a company that's been beaten down, I guess, by a combination of high inflation, high interest rates, a slowing housing market, and that's Whirlpool Corporation. I think everybody understands what Whirlpool Corporation is. They make appliances, both big and small, residential and commercial. Basically, what's over the past year and a half, it's been really challenging for them because of the things I just mentioned. Inflation kind of attacking their cost of goods, steel costs, things like that have compressed margins. Demand has slowed way down because there hasn't been a lot of like existing home sales. So there's not a lot of new appliances being put into new homes. There's not a lot of refinancing going on or taking out lines of credit to replace maybe a refrigerator that could be replaced but doesn't need to be replaced. That sort of replacement cycle sort of thing. Over the past 3 years, the stock's down like 42% and currently has a 7% or 6.7% dividend yield. And I think there's an opportunity here over the next year or so as interest rates start to get cut. We'll see a little bit of margin expansion, a little bit of growth. They've done some internal things in terms of cost controls. They've divested a couple of their slower business areas, such as Europe and the Middle East, to free up a little bit of capital there. They're still generating enough free cash flow that the dividend doesn't look to be at too much of a risk. And with a 6.7% yield, it doesn't take a lot of growth to satisfy that sort of. It's a pretty low bar to clear, I guess would be the better way to put it on what kind of returns you're looking for over the long term. Whirlpool hasn't exactly been the best performer of the past 10 years, but I think some of the initiatives that management is making this past like year and a half has been a real kick in the pants for them. And I think they're starting to find religion in terms of generating returns, improving margins, things like that, that over the next year or so, as these kind of interest rates cuts start to trickle into refinancing and things like that, this could be a decent opportunity.
Yeah, a couple things I want to add there. Whirlpool's long-term performance, one of the things that's weighed on it is it's been a pretty acquisitive business. They've done a lot of consolidation of acquiring some large brands. And companies are usually one of two things. They're usually really good at it, or they're not very good at it at all. That tends to be the case. And with Whirlpool, it does look like those acquisitions weighed on its returns over the past decade or so. But I think, Tyler, to your point, with the leadership team that's in place, a refocus on generating returns for the business, which should translate to returns on a per share basis. all of the worst of that is through. The thing I like about this idea the most, Tyler, is I think the dividend is secure. I don't think this is a yield trap. So for investors who are focused on locking in a pretty secure payout from the dividend and they're less trying to chase total returns or trying to beat the market, I think Whirlpool is not a bad, do some due diligence yourself, people, but I think Whirlpool is not a bad choice for investors looking for that. And you could get a nice boost of returns if the stock price does go up, if they do start really delivering on the business results. Tyler, let's talk about something that is completely different.
Normally, that's what we do here.
Yeah, we tend to take two different approaches to try to get to the same place, and that is alpha and generating great returns in your portfolio. I'm going to talk about a stock that is very beaten down over the long term. It's up like 40% over the past year, but from its IPO, from kind of the peak period, down a ton. This is very much a growth investment, and you're taking on some risk here. And I'm going to talk about Upstart. So, Upstart's business is personal lending, not much of the lending themselves, although they do issue some loans themselves that they keep on their books, mainly for testing out new products and for research. The vast majority of the loans they issue, they're the platform. If you go through their press releases, you will see dozens and dozens of banks and credit unions that have signed up to partner to use Upstart's platform for credit worthiness. And then they originate the loans, they issue the loans, and Upstart earns a fee. Upstart also has a big lending business that they're trying to grow for auto loans. And recently, over the past year and a half or so, they've been testing HELOCs, home equity line of credits. That's something that they're beginning to expand into more markets as well, partnering with more financial institutions for that. Now, here's what's happened to the business. Over the past couple of years, Tyler, is interest rates started to skyrocket. That Fed's mandate to tamp down inflation. Remember when inflation was like 8 or 9%? Well, interest rates skyrocketed to levels we haven't seen in 4 decades to fight that. And for a business like Upstart's, where personal loans is still the vast bulk of its business, those interest rates skyrocketed as well, priced a lot of people out, and also created a lot of risk for lenders. Lenders really pulled back from that business. And Upstart went from showing how strong its business could be during like the healthy part of the cycle for lending to burning money, losing money, and burning cash. And the stock's come down a ton. We have seen more recently, I want to share on the screen, we've seen some kind of softening of the weakness. The business, again, the results are still not great. Revenue in the second quarter, they announced it later in August. So about a month ago, down 6%. Operating income actually worsened a little bit. And we did see continued little bit of deterioration in their margins, but some signs of improvement, falling support costs, growth in smaller loans. So starting to see a little bit of traction, and that's a positive sign. So the falling interest rates, I don't want to oversell it, but I do want to say interest rates coming down will make these kind of loan products more affordable, and it will make them a little bit more enticing for lenders as well, who are become a little less concerned about borrowers taking on an interest rate that's just so large they end up not being able to afford it and then defaulting on the loan. So that's a positive sign. The biggest positive for me, Tyler, is how much partner growth we continue to see with lenders continuing to sign up to partner with Upstart as the platform that they want to use to originate these loans. That says a lot about how the market views their product in terms of identifying creditworthy candidates, because the lenders wouldn't be going through this work and signing to partner with Upstart unless they were willing to use the product.
This isn't 100% going to be a sign for Upstart, but I'll call it the directional thing that shows what's going on here. This week, it was just reported that applications for refinance activity rose 11% week over week and is now up 175% from a year ago. This is interest rates for mortgages have been coming down a little bit. The spread between what a mortgage and federal funds rate has been coming down. And so this kind of gives you a signal to show that credit is opening up. People are starting to borrow a little bit more. And like I said, directionally, that is in the benefit for Upstart.